and welcome to Risk Takers Unleashed. I'm Mike Greer. Wanted to do two things today. Introduce you firstly to Professor Campbell Harvey and bring some context to what is going on with U.S. monetary policy and spending, and give it some context with regards to risk and how it affects our economy and investment ecosystem. With regard to Campbell Harvey, he is a professor of finance at Duke University and research associate at the National Bureau of Economic Research in Cambridge, Massachusetts. He served as editor of the Journal of Finance from 2006 to 2012 and is the 2016 president of American Finance Association. He holds a PhD in finance from the University of Chicago. Campbell Harvey, professor, as mentioned, at Duke University's Fuqua School of Business. He teaches a course called Innovation in Crypto Ventures, a course that focuses on the mechanics and applications of blockchain technology. Certainly safe to say he's one of the leading thinkers on both centralized and decentralized finance and macroeconomics. If you're truly interested in DeFi and these types of things, I highly recommend and have taken myself Professor Harvey's DeFi course on Coursera. Check it out over there at Coursera. Very interesting topic, and he does a great job of explaining what can be relatively complex, but does a great job of explaining that to folks like me. Highly recommended that. Also, give him a follow on both X and LinkedIn if you're over there. I'm sure he's on other socials too. Those are kind of the main ones for me where I tend to see his published work. So you'll appreciate his wisdom and insights over there. So he recently published an article that I thought was profound and telling about 7 major risks for the U.S. national debt. Again, over on LinkedIn, it's on X, and again, I'm sure out there elsewhere. I wanted to cover off some high points from this piece and then give you my own takeaways after thinking about his guidance for a while. I'll link the article in the notes below so you can find it that way as well. So Professor Harvey writes, the sharp rise in long rates poses 7 major risks, including the burden of debt service. Interest on the federal debt will become the second largest category of government spending over the next year. So risk 1. Increasing interest service. The average interest rate on federal debt is 2.8%, and obviously it will rise. The total debt service is $620 billion with a B. Let me explain the math. The total debt is $32 trillion. The debt service is the interest carriage on top of that debt. Interest is 22% of tax receipts. It's reasonable to expect over the next year that interest service will become the second largest expenditure category, exceeding health, national defense, etc. He writes, historically, it is a very bad idea to borrow to pay the interest on your debt. Further, the $32.3 trillion of debt does not include many unfunded government obligations. So the actual totality of the debt is far higher than the $32.3 trillion. But we'll leave it at that because that's a profoundly large number. Risk number 2. Financial sector instability. Increasing long-term rates hits bank balance sheets. Most banks are locked into longer-term loans and treasuries. Both collapse in value when long rates rise. Consider banks' holdings of mortgages. From July 2020, 30-year mortgages average less than 3% for over a year. The current rate, 7.3%, is more than double that. This type of duration risk is exactly what took Silicon Valley Bank down. In SVB's case, it was the holdings of longer duration treasury bonds. Risk number 3, credit squeeze. The combination of an inverted yield curve, which hits bank profitability, and higher long rates, which hits banks' balance sheets, has led to the strange situations where banks can only afford to pay a few basis points on their savings deposits. This leads to capital flight to money market funds. The money market funds invest in treasuries and other safe securities, so the capital flight slowly squeezes credit out of the system. This leads to slower growth. Risk number 4, lack of investment. Higher rates increase the cost of capital. Investment spending is already negative. Increased cost of capital makes fewer investment projects viable. Investment is a major driver of GDP. Risk number 5, stress on the consumer. The post-COVID savings glut will be exhausted by year end. These savings have been the main driver of GDP growth in 2023. Some consumers are already depleted and credit card debt is increasing. We cannot count on the consumer to bail out the economy in 2024. Risk number 6, commercial real estate. The vacancy rate in San Francisco is 32%. It's commercial real estate. Chicago is at an all-time high, nearing 20%. Banks hold a substantial amount of real estate debt. While banks would like to roll over into much higher rate loans, they may be unable to do this. Risk number 7, and the final risk he outlines, resumption of student loan payments. 40 million people have student loans. The COVID era pause on payments has ended. It is increasingly difficult to get replacement credit due to a credit squeeze at banks, and higher rates make loans less affordable. So, what does all this mean? Professor Campbell Harvey's article, and what does this mean to us? Lower GDP growth expectations for the foreseeable future. I don't think there's any doubt on that. Debt carriage impacts ability to grow, through higher tax burden to companies and citizens, as well as the drag on government spending due to additional debt maintenance. So that you can expect the impacts to fall out for GDP growth in a deleterious way, shall we say. Slower new job starts and likely increased unemployment growth due to stalled GDP. If you buy the GDP sentiment and impact, then I don't think there's any way around unemployment growth stalling out and decreasing. So again, also lower corporate investment, right? Things like IT spend, new hires, etc. All of that will be impacted in a negative way from years past. So what's the remedy? Higher taxes, decreased government spending, both. It'll be some combination of that in all likelihood to make the correction or the adjustment to this. But I think it is not credible at this point to say the US is the wealthiest nation in the world. We can cover all this. I don't think that that is a viable and compelling topic of conversation at this point. So this has to be addressed. Consider COVID spending, very poorly managed, very reckless. I would say that anything on top of this debt burden where we are now is actually beyond the pale. More spending, just say no. Nancy Reagan in the 1980s, just say no. Let's consider real estate. Right? We talked a little bit about the commercial side of real estate, but what about the residential market? Right? We just had the slowest mortgage applications month since 1995 for residential mortgages. So in other words, applications for new mortgages has gone down to a level that we haven't seen since 1995. So that's a long time ago, and something to consider. Hard to see where the increased mortgage rates do not ultimately stall the residential market at this point. What did we say? 7.3%, or Professor Harvey references 7.3%. This is now a level of borrowing that impacts not only sales, but ability to purchase certain levels of housing. So the average buyer who's on relatively fixed income through something like a W-2 salary or living on pension, there's not a lot of room to accommodate higher interest rates without a decrease in your own standard of living. So that's what we're seeing. It's really hard to see where the increased mortgage rates really don't ultimately stall the residential market at this point. So the bottom line, right? Adverse conditions for real estate buyers, no question. Borrowing more to buy less. For sellers too, who are starting to experience a decrease in the buyer pool, certainly in certain market categories. If you're locked into a 30-year rate at 3%, you'll be somewhat reluctant to flip your house into a 7.5% mortgage to move or upgrade your home, whatever that may be, even though you may have kind of a CapEx appreciation on your house if you've been there for a while. So hard to see how all this doesn't really ultimately pan out and stall the residential market, a lot like the impacts that we're seeing in on the commercial side. Let's think about money supply, right? The more money that's out there, we all know this, the less valuable the US dollar is, and it impacts inflation. We've certainly seen that in past years. These are cautionary times, to say the least. I think we can say that as a baseline. So how to interpret all this? What do we do? The raise in interest rates is intended to curtail inflation. We are probably well past the point where high rates are actually helping that. And more likely, the Fed rate is causing real damage to the economy vis-a-vis stalled investment due to cost of capital, as well as imbalanced risk to reward ratio for banks, investors, and lenders. In other words, we're probably past the point where this this high Fed rate is actually helping and is probably hurting at this point. I think Professor Harvey would agree with this sentiment, but I will let him speak to that of his own accord. Put it this way. At the time of this broadcast, again, the yield on the 10-year Treasury touched a 16-year high of 4.8%, up from 3.3% in April. Last week, the 30-year fixed rate, as we discussed, hit 7.3%, the highest rate in 23 years. According to mortgage buyer Freddie Mac. So, I mean, and the banks, predictably, why fight the long bond with returns like that? You have almost a no risk 4.8% coming your way, as opposed to, loaning out something at a near similar rate that has much higher attendant risk. So that's why the long bond is such an attractive investment, at least to this point. Talk about government's involvement in this, and I think it's hard to separate that out with any kind of rational conversation here. Congress, both sides of the aisle. Let's be frank and brutally honest here, as well as the executive branch. They're now to be considered reckless spenders. There's no way around that, with very, very few exceptions. So via their Fed and Treasury policies, both Congress and the executive branch continue to place the taxpayers and business environment at risk. With what can only be considered low return on investment expenditures. I think the time is right now for single issue bills. In other words, no more omnibus spending programs, right? No more 1,200 page bills. You need to justify the expenditure on a single line item basis. Everything on the balance sheet must be accounted for. No pork, no earmarks, no special favors. And again, this is not a single party issue. This is a national debt and debt management crisis that we're in. It's being forced onto taxpayers and future generations, those who will have to actually pay this back. So finally, consider the impact to the devaluation of the US dollar and where to place your own investment bets in all of this future. The case is being made for real assets, I think, without question. So real estate, again, all on a longer term basis, metals, commodities, etc. Do your own due diligence, think this through, but the idea of just holding in US dollar is not going to be a safe place to be. I think we've begun to outline the case that the bond market is also potentially at risk. And so these traditional safe hiding places are not necessarily such a safe haven anymore. Take a long, hard look at your equity portfolio. I certainly have. And consider what part of your valuations are driven actually by monetary supply. So this is an interesting thing to do, and I highly recommend doing it. Cut and paste an M1, M2 growth curve over the growth in equities markets over the past, pick your time horizon, 5 years, 10 years, whatever you like. I think you'll find some interesting parallel there. So just cut and paste a money supply curve over a Dow curve, an S&P curve, a NASDAQ curve, or all three of them, even single issues, right? And see if the real growth has come from a positive economic environment, or see if it's been inflated by monetary supply and lack of real investment options. I think you'll find some startling results by doing that. So in any event, wanted to wish everyone a great day. I want to thank you for listening and look forward to our next conversation. Have a good one.